Welcome to Heritage Financial's 2022 Market Review. Looking back at the 2022 year, there's no doubt that the major story was the Federal Reserve's monetary policy in increasing the federal funds rate from a range of 0 to 0.25%, all the way up to 4.25% to 4.5%. This major increase in interest rates obviously drove down bond prices as the yield curve was not steep enough and did not anticipate as large of a movement as we saw in rates. As rates moved up, you also saw risk assets sell off, and we had the coincidence of both the stock market going down and the bond market falling at the same time. That results in a very tough year for investors, as asset classes that may offset each other or at least be buffeted by very low volatility in bonds simply didn't work this year. However, there is a couple of important points to make. As tough as those numbers might look for the whole year, they looked worse after the first 3 quarters. So if we look at the global stock market and the US bond market, they were down over 25% and 14.6% at the end of the third quarter. We actually had a very good fourth quarter, both for stocks and for bonds. Stocks almost notched a 10% quarter, 9.76%. And if you look at a bond return of just shy of 2% in a quarter, that annualizes to a fantastic rate. So have we already turned the corner? Are we already on the way back in both the stock and bond market? We'll see, but this certainly was a good direction at the end of the year. As we look at what happened as markets recovered, a few important themes are shown. First, we saw that in the downturn, the tech stocks, the relatively high-priced stocks had fallen more than value stocks, so value had outperformed growth. One of the questions was, if a bull market resumes, are we going to see growth outperform value on the way up? And the answer to that, so far at least, has been no. So as we look at the bull market in the fourth quarter, positive return to stocks, you actually see value leading by a very significant margin, up over 12% compared to just over 2% for the growth side of the market. So value seems to not just be protection on the downside, but something that lags a little bit when you see a much better recovery in prices. In fact, we are seeing that on the upside, value is outperforming. The other thing is the non-US developed markets, up 17.33% in the fourth quarter. A lot of folks that think about markets, one of their major concerns has been in the developed international space with the geopolitical events that have a direct impact at the European continent. You see a lot of people who would say, I would want to stay out of those areas. Those are the ones that are going to do the worst. Those are ones that are looking at the highest headwinds. But often markets surprise you, and prices generally reflect risk. So what we've seen is that in the fourth quarter, developed markets have done quite well, which to many might seem counterintuitive. The other thing is during the first 3 quarters of the year, it was obviously bad to have interest rate risk. If you were longer in your bond portfolio, you tended to have worse returns. Same thing in terms of yields. So you had credit-related markets, credit spreads had increased over the course of the first 3 months, and credit-related bonds had underperformed higher quality bonds. Take the fourth quarter, and you do see a flip in the regime. So in the fourth quarter, longer-term bonds outperformed shorter-term bonds. Duration was helping you. High-yield bonds outperformed higher quality bonds as you started to see some credit spreads come in from the levels that they had gone out to. So again, it's very early, but you do see the signs of markets acting the opposite way that they did when they were falling. You see that the bond market is starting to give investors back some decent return. You see that maybe even at the longer end of the curve, some duration is now something that could be attractive. 2022 will be remembered as a year where inflation had touched a very, very high level, a level that we haven't seen in a long time. You actually tipped over 9% on a year-over-year basis mid-year. But we have seen inflation actually moderate in the data. We're still at levels that are high. You don't want to see inflation coming in at 7% year over year. We believe that that's going to continue to come down. But at least what we're seeing is a deceleration in this rate of change. So as interest rates have increased, you have seen a slowdown in inflation, and now the rate of change seems to be decelerating. The brakes are on. Yes, prices are still increasing, but that rate of increase is slower. I'd said the bond market had got it wrong in 2022. Just wanted to take a quick look at the yield curve and a couple of quick comments here. So in 2022, the Bloomberg US Aggregate Bond Index, so all of the investment grade bonds, roughly a duration of about 6 on average, was down 13% for the year. When we look at the yield curve that existed just a couple of years ago, the ultra short end was pinned at 0, which is perfectly appropriate given that the Fed was going to keep rates down at that level for the foreseeable future. So that was fine. But as soon as you get out to the 1 and 2 year point on that, we should have had a steeper yield curve if the anticipation of interest rate policy was correct. It simply was not there. You actually had a yield curve that was very, very flat all the way out until it started stepping up around the 5 year point. So as you did see the Fed actually increase policy rates aggressively, the bond market had to react. You had a jump in rates, and you had losses that were realized in fixed income, and especially ones that had longer terms. You can see that the bond market is still skeptical. So I would say that if you looked back a couple of years at the December 31st, 2020 yield curve, the bond market didn't believe that the Fed was going to be able to really aggressively move rates up for quite some period of time. Forward rates getting towards the 2% level, you really had to look all the way out, way down the yield curve, and there it was only just getting to that level. Now you look at the yield curve, and it looks like the bond market says, okay, we do anticipate that the Fed's going to continue to increase the policy rate by a little bit. However, you see that it turns negative pretty quickly. So the bond market, again, thinks that the Fed's going to be able to increase interest rates a few times, and then after that, your forward rates actually start to decline. I'm not sure that that is going to play out. At the end of the day, I think you have 2 different scenarios that you could see in the bond market. One is that the Federal Reserve is increasing interest rates, continues to do this to fight inflation, is not going to go and reverse policy to help an economy that's struggling. Maybe inflation doesn't end up under control, in which case I think you'd see the short, intermediate, all the way to the long end of the curve increase materially, and you'd get a steepening of the yield curve up near where current levels are, and then higher as you go longer term. Or you could end up saying that the bond market is right, that it's a pretty darn good deal, that you could get 4% and lock that in for 5, 6, 7 years, and you end up seeing policy rates moderate from where they are now. You end up settling in anywhere from 2 to 3% on your policy rate, and the yield curve normalizes by short rates coming down, and us looking at a relatively flat but moderate curve between 3 and 4%. We tend to think that it is a reasonable idea in a portfolio now to at least pay some credence to that second scenario, where you may actually be looking at a situation where short rates do come down, where your current yields are a fair deal, and we can go and we can lock in higher rates for a reasonable period of time. So we have essentially adjusted the duration in our client portfolios up from where it was to start the year. One of the positives about a bad market is that you tend to see better pricing, which itself augurs higher future expected returns. So when we look at the stock market down 18 1/3% for the year, well, was that all misses on the earnings side? So was your cash flows where your fundamentals worse? Or is there some repricing where your fundamentals are still reasonably solid, and yet you're looking at lower ratios that you're paying per unit of earnings? And the latter is what we see. Couple of quick notes as we look across the different market types. One thing that we have been talking about is the importance of pricing in terms of mitigating downside risk. So when we looked at value stocks, we said you look at PE multiples, they're in the mid-teens, the repricing downwards, you've got a more reasonable floor there. When you looked at the large cap growth space, you're seeing P's of 30. Yeah, you can reprice down from that quite significantly and see some really, really big losses. And that is exactly what happened in 2022. So you see P's in the large cap growth space going from 30 down to 23. That can still go down from where it is today. And that repricing, things like Meta's stock, old Facebook, things like Tesla, those have sustained losses that are up over 50%. And it's a question mark how long those would take to get back to where they were if they are to ever make it back. On the other hand, when you look at the value space, you are at reasonable pricing levels. Yes, you've moderated a little bit as interest rates have moved up, and required returns should also move up with that, but it's only inched down. You've gone from 15.8 to 14.5 in the large cap value space, for instance, and that's part of the reason why value outperformed on the downside and still looks good in terms of its pricing going forward, whether or not we continue to see a contraction or if we end up in an expansion. But across the board, we do see that valuations have come down. It's not all on the earnings side. That makes us believe that future returns roughly should be somewhat higher and come through just based on lower pricing. In a very direct way, we build this into our capital market expectations, and you can see that this is the same case in bonds as it is in stocks. So our expectations for the bond market, very clear why this would be the case. You look over a 10-year time horizon, and we expect returns that are higher than what we thought at the beginning of last year by anywhere from 2.5% to over 3%. If you take 3% per year over a 10-year time horizon, you're talking about over 30% cumulative. That is more in expected returns over the next 10 years than what we've seen in a pullback in the bond market from last year. So again, I know it's silver lining and it's expectations based, but higher interest rates in general should result in a higher total return in the portfolio. Yes, repricing on the bond side is painful in 1 year. If you look over a longer horizon, increasing rates, higher returns, higher cumulative expectations. If we take a look at stocks, more in line with what I said with the moderate repricing, we do think that there's about a 1% or so expected higher return in each of those markets, as we've seen P's moderate without earnings necessarily impaired from where they were before. So getting back some of that pullback on the price element over a period of time. It's important as we go into 2023 to realize that there is a big difference between when a financial market, especially the stock market, peaks and when you actually have an economic cycle that turns over and truly goes into a recession. People are speculating about whether or not 2023 will see a recession. I think that as long as nominal growth rates, even if they're positive, are below inflation rates, you are seeing what I would term a recession, because you're having real purchasing power and real earnings power going down year over year. But that point aside, whether or not the economic cycle has actually turned into a contraction yet does not necessarily mean that there's pain ahead in the market. The market has come down by quite a bit already. And sometimes the cycle peaks and you actually see some of the things that go along with the cycle turning over: higher unemployment, lower wage growth, moderated inflation, come with actually a market bottoming and recovery. And we might be looking at something that's more classically in this pattern than saying, oh, if we end up seeing higher unemployment, bad actual economic data in 2023, that means bad things for the market. I don't think that that's a given. A couple of things that we did in 2022 that I think are very important. So we incorporate asset classes, private real assets and private credit into portfolios. And we generally have held those instead of their counterparts in the more liquid space. So private credit in place of just corporate high yield exposure, private real estate in place of what many in the liquid space would have put in real estate investment trusts or public REITs. And you can see the differentials in return are real significant. So public REITs for the year down 24%, private real assets allocation up over 2%. So you have a 26% plus differential. And when you look at the corporate high yield space, you see a negative 11 print versus just the senior private credit market that was up mid-single digits, 6.5% or so. And here we're talking about a high teens differential in return. The ability to incorporate those private asset classes were a real buoy to portfolio returns for the year, provide rebalancing capital to be able to take some money off of those periodically and buy in at lower prices. And then has also given us some strategic opportunity as we've revised our expectations for each asset class to begin to rotate out of some of those areas that have maintained their values, produced positive returns, and to buy asset classes that have sold off significantly, whether that's traditional fixed income, equities, or in this case, a switch into some things like public REITs from your private real estate allocation. So in 2022, there were different ways that we were able to add value in what was a very tough market for investors where both stocks and bonds were down significantly. So let's check these off very quickly. One is our value preference within equities. We often term that a style-related return, so favoring value style stocks over growth. That was a significant benefit as the value side of the market performed much better than the growth side of the market during the downturn and then also during the fourth quarter recovery. So big benefit by how you structure your equity portfolio instead of just owning the whole market. Second is how you structure the bond portfolio. So we were very, very short duration going into the year. That made it so that unlike a portfolio that held longer term notes and then market rates went way up on them, we had a lot of our capital essentially maturing under the hood, getting reinvested, and now having a higher yield to it. So the shorter duration made it so that our fixed income held up quite well. We've closed the gap now as we've slightly increased duration. We've kind of scaled into that over the latter part of 2022, and it contributed significantly to portfolios producing strong returns in 2022 on a relative basis. We incorporated dynamic bond strategies. So instead of just taking market returns within the bond space, we tried to be flexible when we saw that interest rates just didn't provide enough absolute return to go on the exposure end. Those strategies performed quite well for us. And now we're able to, again, rotate the dial a little bit and go more towards classical exposures to the asset classes as we feel like they're compensated better for the risks that you're taking. Of course, allocations to private credit and real assets, that was a home run last year. Asset classes that produce good positive returns in a year where traditional asset classes were down and down significantly. Again, rebalancing capital during the course of the drawdown, the ability to use some of the proceeds from that if folks were withdrawing from portfolios. So a funding source for cash. And of course, being able to reallocate out of those thoughtfully over time as the market ebbs and flows. And then finally, in a year where, of course, asset classes are down by quite a bit, you end up having opportunities to book losses from a tax standpoint in the current year and then maintain your exposure over the long term. So we've done tax loss harvesting where we've found appropriate situations, take that benefit while we have it. So wrapping that all up, some really good relative portfolio results, good within equity styles, good within the bond market positioning, great when we talk about an allocation towards private real assets and private credit, and then silver linings, taking our tax losses where we can and maintaining exposure in a robust portfolio throughout the period. Thank you again for your trust in Heritage Financial Services. Please feel free to look into our 2023 market outlook to hear what we're thinking going forward.